Good afternoon, everybody. Welcome. I'm your host, Dan Theok, Senior Vice President of Investment Banking. Welcome back to yet another investor briefing, where today we'll be looking at the financial results for NCBFG for the year ended September 30th, 2024. On the panel, we're very happy to have once again Group CEO Robert Amita, Group CFO Malcolm Sadler, and CEO of NCB Capital Markets, Angus Young. Welcome, gentlemen.
Thank you for having us, Dan.
Thank you.
Thank you, Dan.
Well, welcome back to the program, gentlemen. And on the panel here at Mayberry, I'm happy to have my CEO, Patrick Bataille, with me. Welcome, Patrick.
Thanks, Dan.
And newbie, Melissa, not Melissa, Melissa Jones. Welcome, Melissa. Good deal. Well, guys, if you're a fan of the content, then don't forget to subscribe and hit the bell to stay up to date with our channel. We upload content like this just about once per week. And if you want to embark on your very first investment journey, you should take that first step with Mayberry, of course. Follow us on social media to learn more about how you can get started today. And don't forget, folks, we'll be having a Q&A segment at the end of the program, so make sure to submit your questions so we can address them at the end. Okay, so Rob, we'll be happy to kick it off to you. I'm really excited to hear the results for NCBFG. I hear you've met my minimum mark of $5 billion per quarter, so let's get going. Over to you, Rob.
Great, thanks, Dan.
Oh, is Gary with us?
The marching.
Oh, and we also have Gary Parrott. Welcome, Gary. Where did he sneak on? Good deal. All right, Rob.
Okay, thanks, Gary. Thanks, Dan. So yeah, 2 years ago, you kind of gave me the marching orders of the $5 billion per quarter. So I'm gonna take a minute just to put things into context, and then Malcolm Sadler, our CFO, will actually take you through the numbers a bit more. But to put this into context, we spent the last 2 years doing a turnaround. And I'll go back into where we were 2 years ago, but it was a major undertaking, a turnaround of our capital and our financial position, our earnings power, but also our physical plant, our technology platform, the human capital base, and customer experience. So on a number of different dimensions, and all for the purpose of getting ourselves into a position where we get to now. We've had about 2 quarters now of relatively normal performance in around that $5 billion a quarter type earnings range. And the prior 2 quarters had a bit more noise in them, positively and negatively. And they don't fully offset. We got a little bit more of a wind assist from positives, but there were a lot of negative one-offs as well. And so the prior 2 quarters had some one-off noise in there. But the last 2 quarters are pretty well our normalized run rate. And so we were ended September coming out thinking, okay, we're ready to accelerate now. And we are. That's there. But what we hadn't kind of counted on was that it meant that we'd built a resilient foundation, and we hadn't anticipated Hurricane Melissa and the importance of being in the position we are right now, so that we can actually respond to the test, respond to the challenge, and work to build, to not just to build back, but to build back better for the country. And that's going to take all of us. We're just happy that after spending 2 years getting ourselves into a position of sustainability, a position of resilience, a foundation from which we can accelerate, we'll be doing that in the context of really helping the country come back from this unprecedented shock. So with that as a bit of context, I'm going to pass it over to Malcolm, and he'll walk through the quarter and the year in terms of our financial performance, and then we can chat more about the business.
Thanks, Rob. And also thank you, moderator Dan Theok, Mayberry executives and team, investors, shareholders, stakeholders, all guests joining us today. Good day. I will present key highlights for the financial year ended September 30, 2025, compared to September 30, 2024. NCB Financial Group delivered a strong performance this year. We reported consolidated net profit of $36.9 billion, representing a 71% increase, and net profit attributable to stockholders of the company, $23.1 billion, up 73%. And there were improvements in key performance metrics. Return on equity improved to 12.46% from 8.49%. Return on assets increased to 1.56% from 0.96%. Cost to income decreased to 64.29% from 73.56%. The results also included the net positive impact of the gain from the sale of the subsidiary in Q2, which was partially offset by certain one-off operational losses and adjustments relating to prior periods. The performance for the year was driven by an overall growth in net operating income of 20%, net revenues from banking and investment activities up 18%, including a gain of 15.1 billion from the sale of a subsidiary. Insurance service results improved by 33% due to continued growth in core business across the region. Group revenue growth was partially offset by an overall 5% increase in operating expenses. If we go to the next slide in terms of our performance bridge and the key factors that drove our core performance. Net interest income increased by 7%, with expansion in net interest margin, growth in the investment portfolio, and reduced funding costs. Insurance service results was driven by a 56% increase in the property and casualty segment and a 21% improvement in the life, health, and pension segment. The revenue growth was however partially offset by higher net expenses from reinsurance contracts held. Finance expenses from insurance contracts issued up 20%, driven by fair value of unit-linked assets and interest accrued, and also the effect of changes in interest rates and other financial assumptions. Gain on foreign currency and investment activities increased by 4% due to gains from the sale of debt and equity securities, coupled with higher foreign exchange income. Credit impairment losses increased by 18%, mainly in relation to receivables in our insurance segment and credit in the banking segment. Staff costs increased by 7%. Taxation expenses up more than 100%, resulting from the higher taxable income and lower deferred tax credits. If we go to the next slide to look at our segment results, all segments were profitable, and 5 of our 7 segments recorded improved operating profits, underscoring our diversification, resilience, and execution of our strategic priorities. The 5 segments that were up from 2024 are life, health, and pensions, up 61%, which includes the gain from the disposal of the subsidiary. Treasury and correspondent banking up 6%, reflecting the execution of the pricing strategy and balance sheet optimization. General insurance up 87%, mainly due to improved net insurance service results, lower insurance finance expenses, and higher gains from investment activities. Wealth, asset management, and investment banking segment up 259%. Increase in net interest income, gains on investment securities, and improved fee and commission income. Payment services up 96%. Increased transaction volumes, increased net interest income, and net fee and commission income. Both the card issuing and acquiring recorded growth in transaction volumes, partially offset by higher operating expenses, driven primarily by increased card rewards earned by our customers. The 2 segments that were down from 2024 are corporate and commercial banking, down 4%, mainly resulting from lower net interest income due to a decline in the loan portfolio. Consumer and SME banking also down 11%. This segment continues to deliver growth in net interest income and net fee and commission income. However, the performance was tempered by higher credit losses and operating expenses. If we go to the balance sheet on the next slide, in relation to our financial position, total assets of 2.41 trillion, up 4% from the prior year, primarily due to investment securities of 1.27 trillion, which was up 8%. Loans and advances, a small 1% decline, as our focus was more on portfolio optimization. Customer deposits up 3%, to a record level of 809.4 billion, which reflects continued confidence in the group's financial strength and service offerings. Insurance contract liabilities up 2%, reflecting growth in our insurance business across the region. Consolidated stockholders' equity up 21%, and equity attributable to stockholders up 16%. And this was primarily due to growth in retained earnings. And we're at this point seeing a book value in excess of $70, closer to $80. A book value per share that is attributable to stockholders. Capital and liquidity, all regulated entities were in excess of capital and liquidity requirements. And we also declared a Q4 dividend of 50 cents per stock unit. In relation to the hurricane, the group is in the process of assessing the full financial impact of the hurricane, and that's Hurricane Melissa, and the potential impact via credit losses and insurance claims. Additional information will be disclosed as it becomes available. I will now hand back to our group CEO, Rob Almeida, for some comments.
Thanks, Malcolm. So that was a good overview of our performance. Yeah, we can probably just jump into the questions. I think the main point I'd like to make is the importance of the capital strength that we've built over the last 2 years. We had some other milestones over the last year. We completed the 144A international bond offering. That termed out, so it gave us, from a liquidity perspective, it termed out our maturities over a longer period of time. So it reduced the amount of refinancing risk in our balance sheet. It pumped about $200 million US into the region that actually got repaid to investors in the region. And that's a substantial amount of foreign exchange that came back into the region. It also reduced the amount of saturation of investors who are exposed to us in the NCB Financial Group, through the various products and business lines we operate. And so we diversified our investor base, which is really important to us, but also important to the region, because obviously in times when you need more capital, it's important to have access to, like we do through the reinsurance that we do through Guardian, as well as to the investor base that we have through the securitization bonds that we have, and now including the 144A international bond offering at NCB Financial Group. So all of these gives us access to capital for times like this when it becomes really important. So I'll finish off by saying we did the last 2 years on the anticipation it was what we needed to do to turn around NCB. And get it ready to accelerate its performance improvement. We also did it because it was good to strengthen the foundation. But really, when you hit a time like this, you understand that what it actually did is it made us ready. We're in a really, really strong position to meet the challenge of the times, and as Malcolm said, it's a little uncertain. There's assessments to be done, but we're very confident that we're in a really good position to help the country build back better. And with that, I'll pass it back over to you, Dan.
Thanks, Rob. Appreciate that, and Malcolm, I appreciate that. So I do a little spiel myself in terms of the analysis, but you guys did a pretty good job over the numbers. So I don't want to go over the numbers, but I do want to sort of speak to the financial stats. So guys, if we could bring up the chart that has the graph, I just want to, while we're on that chart, sort of speak to how I feel about the stock price. So the chart that has the graph, that's the one we will go to. So trailing earnings of $23.1 billion, right? So congrats, guys, there. You've done better than $5 billion a quarter, which is what I kind of feel is like the minimum hurdle for me to be happy. So with $23.1 billion of earnings, $2.58 billion in shares, that's an EPS of $8.95. Stock closed roughly at $40, which gives you back a PE of 4.4 times. So folks, this stock is trading ridiculously cheap at 4.4 times in a market where the Harmean average is closer to 8.5, but should really be 10 times. So this stock at a 10 times multiple is a $90 stock, right? $89.50. So I said the EPS was $8.95. So 10x PE, its stock should be really at $89.50. At 8.5 times, the stock should be at $75. So the stock is undervalued by every stretch of the imagination. Shareholders' equity, $199 billion. So if we try to work out the book value, again, you get a book value of $77.15. So the stock's even trading at like a 48% discount to book. I mean, there's a solid bank trading at a discount to book when most banks should be trading at a premium to book, maybe at 1.1 times book. So, folks, this is why I think, NCB is ridiculously cheap at $40, and why I think, it's just a matter of time before the market corrects, whether it's 8.5 PE or 1.1 times book. It's all taking me back to sort of $90 stock price, and that's where I sort of hope to see the stock price trending over the next 4 quarters. So we do want to get through the next 2-3 quarters. We totally want to appreciate, guys, and we'll delve into that a little bit. How do you feel about the next 2-3 quarters, about Jamaica in general, right? So it's not just how does this directly impact you and into your 4 main lines of business, but how do you feel about the economy overall, and will you be able to continue advancing and growing your asset base, which is now over $2.3 trillion? Again, impressive. Will you guys continue to be able to, keep delivering great results? So with that, I've got one question, and it's prompted by what you just said, Rob, and then I'll kick over to Patrick and let Patrick lead off with two follow-up questions. So the Reg S or the 144A bond raise that you did, congrats. Great to see you going back to the U.S. capital market, bringing $200 million of liquidity into the space, which frees up liquidity for all of the rest of us. But I'm going to ask this question. It'll probably be the only one where I'm probing kind of negatively. Did you think it was too expensive? How do you feel about the pricing that you landed at the end of the day, Rob? We thought you could, get that money at 8.5%. You end up getting it north of 10%. How do you think about, the price you've had to pay to get that liquidity and certainty for your balance sheet going forward? Mind you, it's only $200 million in the overall scheme of your book, but how did you guys feel about where the raise landed?
So obviously we would have liked to have had it cheaper, had a lower rate on it, but at the end of the day, it's about the resilience is more important. And so that was the focal point of the resilience for our entity as well as for the region. So bringing in the liquidity into the region, bringing the capital into the region, but also terming out our just de-risking our own balance sheet. From a cost of capital at 11%, on the one hand, we look at it as saying that's higher than we would have liked for debt. On the other hand, was when we're at around 13% return on equity and growing from there. So it's still accretive in terms of our overall return on capital and return on equity. So therefore, we were comfortable with it. Like I said, and we think it was necessary for us also to get in a position where, on average, while this particular security is at an 11%, on our overall credit stack, if you will, we're able to use the fact that we've got the term much more flattened in terms of our refinancings going forward, that actually the rest of our portfolio or our issuances are actually averaged down the overall blended rate. So between debt reductions, other debt that'll refi at lower rates, we think being in a much stronger capital and liquidity position was worth paying the little extra. And to share this, we've worked on it for about a year, and we went through election, tariffs. I don't know how many different things happened with the U.S. markets during that time period where we were one step away from launching, and then we'd be told, "Oh no, can't do that now. Something just happened." Then global markets are closed off. So I think there was also that opportunity of saying, when the window is there, you just take the opportunity, de-risk the balance sheet, and then just focus on improving the business.
Good deal. And then I'll turn it over to Patrick. So long story short, you didn't have to flag Angus for that, right? You didn't blame capital markets guys for dragging out the road show.
Not at all. Not at all, Dan.
Good deal.
So capital markets did support the bond issue, Dan, in a significant way. And I think Rob is suffering from a little bit of modesty. Those bonds are trading at a premium not too long after they were issued. So timing is a hell of a thing.
Yeah, naturally. And look at, I still think it's a great job because you brought a lot of liquidity into the region. It's great to see, a Jamaican company going to the U.S. capital markets. I don't think people appreciate this. Although if you're on the North America side of things, which Rob, you can appreciate, $200 million is a small raise in the U.S. capital markets. But for Jamaica, this is a great step to help our capital market develop, right? To see Jamaican issuers going into the U.S. capital markets and doing debt raises. So that's certainly a great thing. So kudos to you guys there. Hey, Pat, any questions from you?
Yeah. So I see there's a roughly 12.5% improvement in ROE. Just curious, how much of that is structural versus cyclical or one-off, and what is a true realistic medium-term ROE for the group?
So we're medium term. So yeah, medium term. I guess I won't say long term. So medium term, we're working towards this, working completely with targets of 15 to 20% ROE, dividend payout approaching 50%, and that would get us into like a 7-ish% dividend yield on equity. So I would put that out, Patrick, as medium. That's not like long term aspirational. That's actually very much over the next 2, 3 years kind of thing, and hopefully sooner. The normalized for the last year, as you mentioned on the ROE, we probably ran normalized at around $20 billion for the year. And so you'd say the extra $3 billion was the net of the one-off sale of Toma, which was the insurance subsidiary that was sold in the Netherlands. Remembering that we don't own 100% of Guardian, so we only get our share of that gain. Although the top line number on that is $15.1 billion, the net of minority interest is smaller. And then we had a number of cleanup items that we took in the first 2 quarters mainly on operating losses relating to prior periods. That is just part of us actually cleaning and tightening up our internal controls and getting our balance sheet into a much more cleaner position. So around, short answer to your question is the normal is around 20, so that's probably in around 12-ish type percent right now historical on the ROE, and going forward as we look ahead to 2026, a little bit of not a little bit, but a whole lot of uncertainty related to Hurricane Melissa. But we're still looking ahead to getting into that 15% range, if not in 2026, then in 2027.
Thank you. And then one follow-up question. So I know Malcolm talked about 5 out of the 7 businesses did well. Where do you see the strongest earning growth over the next 12 to 14 months along those business lines?
The strongest earning growth is probably going to be in the banking parts of the business. So I think corporate actually. So if we just talk about Hurricane Melissa for a moment, so without Hurricane Melissa, I would have said it would be relatively balanced. There was no particular part of the business that we were expecting to accelerate more, maybe wealth management. But with Hurricane Melissa, I really expect the corporate and investment banking part of the business to grow faster. The two sides of Hurricane Melissa in the short run, the impact of Hurricane Melissa is it's a tremendous human toll, right? Like it's just the human toll is stark, devastating, hard to put words to it. And the physical damage in the country, again, hard to put words to. The rebuild is probably the largest CapEx, the largest CapEx volume that's probably happened in the country, possibly ever, and definitely for a long period of time. And so that rebuild effort, largely on the corporate investment banking side, we're in a very good position. That's what I was trying to refer to, that by having the $200 billion type capital base, by having the liquidity that we have, by having the technologies, our technology platform in the cloud and solid and ready to go, by having the physical network, our branches, our reach, being in good shape. So our physical plant came through the hurricane quite well, actually. And so on our people, they all accounted for, which is fantastic. But secondly, they actually came back to work relatively quickly. So notwithstanding some of them dealing with their own personal things at home, but they all came back to work. And so we're really well positioned and ready for this incredible amount of capital that has to go into rebuilding. And that, yeah, that'll put Angus on the spot to say we're really well positioned to support that rebuild. We have to show up. We have to step up, and we have to show up, because not just us, but all the rest of the financial industry needs to step up. But us as the largest, it's really important that we step up, help allocate the capital to the right places, because it's such an enormous amount of capital that's coming in, that it has to get allocated properly, and it would be a terrible thing that, on top of the damage done, to waste and misallocate that capital would be a terrible thing for the country, because the medium to long term of the country, this is a phenomenal. It's hard to see it right now, but it's actually an incredible opportunity to rebuild better, to rebuild with new technology, to rebuild with the latest, with everything that's changed over the last 10 years. A 10-year-old building may be lost, but it gets replaced with a brand new, modern, smart building. And that, even we talked a little bit earlier, Dan, about some of the wind farms and solar and things like that. As you know, that technology has advances regularly. And so when you're replacing 10-year-old solar panels with new solar panels, it's a big step up. So we play a big role in that. And so I would say corporate investment banking is the area of the business that I would expect to see the greatest growth in.
Thank you. No pressure.
Absolutely.
No pressure, Angus.
Absolutely no pressure, Patrick. None whatsoever, right? So don't take Rob's word for it. From January to September 2025, NCB Capital Markets has done 20% of the number of transactions done in the domestic capital market space, but dollar-wise is 47%. So 50% of the capital raised in the domestic capital markets from January to September 2025 was done by NCB Capital Markets. Now, we've done two very significant things to poise the bank to take advantage of what Rob was speaking about, and that is, one, we've merged the corporate and investment banking divisions. So we bring two very large revenue generating divisions within the banking system, operationally merge them, and therefore we have this agnostic behavior where we approach transactions as one. That creates a lot of synergies from streamlining. It maintains margins, and of course it allows us to scale in the hunting efforts. So we're mid-flight where that's concerned. So Rob is very right in terms of what his expectations are going forward for the corporate and investment banking division. And then secondly, we're now putting the finishing touches in creating what we call an investment management center of excellence. So it is public knowledge that the NCB banking group would have sold its pension business to Guardian, and I'll expound on why this is so important. We acknowledge that in the past we have operated in a very siloed fashion within NCB and within NCB-FG. And over the last 2 years, what we've been doing is smashing those silos. So what we did, in effect, long story short, is that we realized that Guardian are the very best pension administrators, given the people and the IT systems that they possess. They are best poised to administer pension plans. Then we say NCB Capital Markets portfolio management skill sets and talent are the ideal place to have portfolio management take place. So in effect, what we did was we moved all pension plan administration in the NCB Financial Group, with the exception of Clarion, to Guardian. And we've moved all portfolio management in the NCB Financial Group, with the exception of Clarion, to NCB Capital Markets. This creates a center of excellence at NCB Capital Markets that with these types of assets alone gives us in excess of 3.5 billion US dollars under management. And that does not include balance sheets that we maintain that are lending balance sheets in Trinidad, for example. Why is this important? Because it creates depth, continuity, scaling, economies of scale, better negotiation. So Dan, when you do a deal, you can't come to one side of the business and sell it at a certain price and another side of our business and sell it at a different price. We have one channel that's going to get these economies of scale, better pricing, better negotiation. We're scaling the talent and building depth and continuity into a team. So the benefits from what we've done in recent times with respect to merging corporate and investment banking, establishing this investment manager second center of excellence, you're going to see those benefits start being realized in our fiscal year 25-26. So Mr. Almeida is very correct in terms of where he's pointing to see the large growth areas. And I do realize that I take responsibility for those statements. So I say with confidence that we will continue to deliver for the group.
Thanks for that. Appreciate that, Angus. Gary, you've been relatively quiet. Any questions from you, Mr. Perry?
Yeah, several. Thank you guys. Welcome again. Well, Angus, you still have a far way to go with the delivery of that, but so far, good luck to you. The first question I have is, your comment, Rob, about getting to 50% of profits for dividends. At 50 cents a quarter, $2 per annum, that's about 5 billion. You use a normalized run rate of 20 billion, so that's about 25%. At what point would investors expect to see you start moving the dividend closer to 50% of the profit?
So we've got a little bit more. So what are the uses of capital, right? So Gary, you know this well, which is you have money, you have a choice to use it to invest. So the idea is keep 50% for reinvestment in the business, and then we have money to pay down. You can pay down debt, you can dividend it out or you can use it for further acquisitions as the alternative uses. So we still have a bit more debt reduction to go, but we don't expect to have to use our free cash flow for that. So we've got some trends kind of continue to do a little bit more on the specific transactions that we can use that will enable that debt reduction, which then means that once that's actually done, then we're able to start increasing the dividends because we don't have to use some of the free cash flow towards further debt reduction to further de-risk the balance sheet. So timing wise, it's hard to put a specific number. Our first goal was to stabilize it and at kind of the 50-cent rate, and hopefully we'll be doing some kind of year-end dividends for 2026 that start to top it up, and probably in around. But I'd say over the next 2 years. So Gary, in my mind, both the 15% and getting closer to the 50% payout ratio is over the next 2 to 3 years, and hopefully over the next 2 years. So kind of a 26, 27.
Yeah. So a follow-up to that question and into other questions. The one-time gain, I agree. I've noticed you guys may have used the opportunity to take a bath in other areas. But there's still excess. Given that it's cash that was generated, what about a special dividend to pay that out?
So what we've done with that, first of all, it was in Guardian. So we've actually used that to shore up and strengthen, again, the capital within Guardian and its own. Yeah, we're building up more of a resilient warehouse, a capital warehouse in Guardian, all in the context of building up more resilience. So at this stage, short answer is we don't think it would be the most appropriate thing to pay it out to pay out more of a special one-time dividend, especially in the context of both any uncertainties with response to what's coming along from from Hurricane Melissa in terms of what does the future look like on that. And secondly, in terms of our own, like I said, we still got a little bit more to do on some transactional stuff to pay down debt. And so we want to make sure we get those done and out of the way so we have a higher degree of confidence. And another quarter or two of run rate, I'll call them Dan $5 billion profit quarters. That will help us also feel highly confident that that we are on that run rate. I will point out, while I keep talking about the $5 billion quarter, just so that as people look ahead to the next quarter, it's the asset tax quarter
Asset
for
tax
Jamaica.
quarter, yeah.
And as the asset tax quarter, it's the one that'll have that as a one-time hit for the year in that first quarter, along with the Guardian hit on Hurricane Melissa is a deductible limit, so it's not, at the end of the day, it's not that material, but it will depress that quarter. But on the whole, we'd like to get another couple of quarters of stable profitability, as well as get the transactions that we're doing to reduce the debt further, get that behind us, and see a little bit about how Jamaica is recovering from Hurricane Melissa. I think the combination of those three things would give us the confidence to start increasing the dividend.
Well, you kind of alluded to my next two questions. I mean, obviously, the second one was the asset tax. I mean, are you part of the lobby? Because the reality is that when asset tax was introduced, it was for a fixed period. It's now about 10 years since that fixed period has ended. And it is a big disincentive to capital formation. What is NCB doing about that? I mean, are you part of the lobby to get the government to remove that tax? Because that would be, I mean, one could argue that that is one of the biggest impediments to an increased dividend from the business.
It is a direct transfer from shareholders to the government. I mean, it's a one-to-one. Effectively, it's a one-to-one transfer, and one is on assets and the other is on equity because it's an asset tax on assets. We talk about a 12-15% return on equity. We would definitely be aligned with, and we will have vocalized. I don't know that one would say, I don't know that we're part of a lobby group, but we would be aligned with the views that the asset tax, it was intended to be temporary. It should be removed. We think it's right for the financial industry. We think it would be right for the country. So we've vocalized that. Like I said, I think we're aligned with the voices that you hear speaking. We have vocalized our view on it. I don't know that we're actually part of something that I would call a lobby group. And having said all of that, Trinidad is introducing an asset tax as well, and so we are dealing. We'll deal with that as well. I think one of the things that I would say, in the context of taxes, when the asset tax was introduced in Jamaica, it was introduced at a time, coming out of JDX, NDX, all of that through that time period, and there was almost a request to say there's an asset tax going on the industry, to a great extent, don't pass it on to the customer. And when you embed it for this amount of time, people want to know why interest rates may be sticky, may be high. Well, asset tax is a direct hit in there, and it's a significant portion of spread, so it directly impacts interest rates in a material way. And I think when we look at it same thing in Trinidad, it's a cost inflation. Globally, they'll talk about tariffs, and the point is a tariff will be inflationary, and an asset tax is inflationary.
Yes.
Thanks for that, Rob. My last question.
Rob, just to put it in
Right?
context, Gary,
Mm,
for the local group, for the Jamaican side of the group,
mhm,
the asset tax is ranging between 2.5 to 3 billion
mhm.
in total. So as Rob mentioned, if you're looking at the impact on Q1, which is when it is booked.
60% of profit.
Exactly. Yeah. exactly. Just to
No,
put
no, no, I understand, which is why, you know, you guys should be standing on top of the tallest tower from Blue Mountain and saying this thing needs to go.
Yeah.
But more importantly, I think you need to let people understand that, you know, pensioners benefit greatly from the dividends that NCB pays. So you're not only impacting the large shareholders, you're impacting a lot of the smaller shareholders. But my final question, guys, do you have a range of what you think may happen with Melissa? And I'm saying this against a backdrop that on the face of it, you know, a lot of people assume it's going to be negative to businesses like NCB, etc. From the perspective that you may have bad loans, you have insurance issues. But one of the things I'm seeing is that it actually can be and is likely to be a major positive. Because a lot of your bigger businesses had adequate insurance, that cash is going to flow into the country from outside of the country. And a lot of the damage that you see, and again, I'm not downplaying people suffering, but a lot of the damage you see is coming from people who were not insured and, you know, probably were not in structured homes, businesses, etc. So you might actually see a massive surge in requests for credit. And I just wanted to get an idea in terms of the different models you have. You know, what is your expectation? I mean, I've actually noticed that you guys have been taking much larger than normal provisions in the last couple of years, which I think is management's way of using up that one-time profit. But at this stage, I think you're very well capitalized. I think you're very well provisioned. You have your key customers had they required insurance, right? And so at this point, I mean, what are your projections suggesting? Are you looking at a slowdown in profit? Or are you looking at a increase in profit? I mean, what are you guys seeing?
Yes. So two things I'll say to you, Gary, as you're I think I'm aligned with your way of thinking on it very much so. As you know, as we're looking out, it's very hard for us to make any type of prediction, right? So I think we'd hesitate from doing that. But I'll tell you, you know, you're one part financier and you're financial guy and you're one part entrepreneur.
Right.
And as an entrepreneur, you know that economists predict stuff, but it's wrong probably more times than it's right. And economists, when they're predicting, they're trying to predict what the Gary Perts are going to do. They're trying to figure out what the actions of all of us who will actually create tomorrow's economy how we're going to react to the various activities that happen. And they have models that try and predict how we are going to all collectively behave. The reality is tomorrow will be very much a function of what we all do. Like you said, there's a whole bunch of foreign money coming in and there's a whole bunch of activity, and we get to build it with technology that is so much better than the technology that built the stock, the physical stock that is no longer there. And so hence I said the corporate investment banking, you know, that would be my push, my expectation, my drive is we have a real big role to play in how the country builds back. We have to be very smart about it, but we have to be very aggressive about it because we have a big role to play in how the country builds back. I'd like to see us really grow through this period. I'd like to see us work with our customers, work with partners to actually grow the economy, use the boost that comes from all that foreign exchange that's going to flow into the country, all that reinsurance money that's going to flow in, all of that, get it working hard. And yeah, you and us have a big role to play. So when I see the economist models and it flows through our projections and our stress tests and all of that, yeah, I can't tell you that we don't have all those stress tests. We have all of those stress tests and all of these things. They don't look good. You'd get depressed when you look at them. But when you actually think about it from a very first principles perspective, it's about what we do with the biggest inflow of capex of FX that's come into the country in like I said, probably ever, but definitely in a long, long time. and it is up to us and you and the other players in the financial system in the country to actually make sure that money goes to good work. And we're determined in our space to make sure that we recognize the role of being the largest, being being indigenous, being the largest, and working with the parties that we've worked with for a great number of years, customers and partners. So I'm trying to, what am I trying to do? I'm trying to balance the part that I am not allowed to tell you what we think the future could look like. And at the same time, I'm trying to tell you that everything that we're going to do is actually about saying this should not be something that sends us into the reverse. This is actually something that should send us accelerating forward, because that's the big opportunity that sits in front of us.
Thanks, Rob. Final question. You talk about paying down your debt. You're talking about using your cash resources. Your major shareholder continues to be challenged by his issues. But the stock price, as indicated by Dan, is probably trading at, based on Dan's number, at 50% of its true value. In my numbers, it's probably about 30 to 40%. You have all this cash. Is there some contemplation to a share buyback?
Yeah, no, we don't see doing a share buyback. We've kind of thought about it. We think that that continuing to focus on the dividend, increasing the dividend, is the more appropriate way to go. We're not looking to reduce the capitalization of the group. And so the idea is actually to get the stock price to reflect its true value, increase the ROE so we're more investable, and in that situation, actually, hopefully, if everything else that I said comes true in terms of Jamaica is able to come out of this situation in a good way, we'll actually make, everything we want to be an attractor of more capital to the country, to the region. And that's the goal. The goal is to bring more capital in, and so we're not looking to we actually deliberated that when the stock price went way down, and just said, like, this is crazy, we should just go do a stock buyback. But it's then after deliberating
Yeah, but Rob, I mean, that was due to one major investor selling off shares, right? And then you had this whole foolishness with this poor little guy with 2 shares that y'all got crazy over. But that major investor is out of the market. The other major investor is embroiled in discussions with the creditors. So there's a supply. There's no longer a supply challenge, right? And so you allude to the fact that you're looking on ways to move the price. I don't know what those things are. I don't know if you could elaborate on it. But as I said, the two main supply issues on the stock, has basically ceased. So a share buyback sends a good signal. So again, I put it out. You've given the answer on that. So I won't focus on it any further. But as I said, the 2 main drivers that drove that price down artificially, for want of a better word, are out. So you've seen the stock recover to 40, and I mean, it can recover much further given these results and continued results.
Thanks, appreciate that, Gary.
Yeah, no worries,
All right.
Gary. While they're not contemplating it, I was buying it like crazy at 28, 30, 32. I've broken all of my rules about concentration risk for NCB. I'm going to be frank. It's just a great stock. I'm in love with it. So Melissa, not because of Melissa have I been ignoring you, but I'm sure you have a question or two to ask. Melissa Jones.
Sure. So I'll just ask a 2-part question. Earlier, when Malcolm was talking, he spoke about NTB's financial strength, and he spoke to the 618, that loans fell by 1% to 618 billion. But I want to shift to the non-performing loans, which increased by 6% to 28.8 billion, pushing your NPL ratio up to 4.5%. What is the expected impact of the higher NPL ratio on credit costs for 2026? And how is management going to balance risk appetite with your growth target, which Robert spoke about banking being the sector that you expect to have more growth in?
Yeah. So in terms of the NPL and provision for credits, as Gary alluded, we again, I'm going to punctuate it on Hurricane Melissa. We have to see how that plays out. But otherwise, we would have been looking at saying we were, as Gary noted, we were cleaning up, getting appropriately provided. We felt the overall, as Bruce would normally say, the overall credit origination, at origination, our credit quality is pretty good. We felt that our collections management and our provisioning could be more conservative, and so we've spent the last 2 years building up our coverage ratios on NPLs and on our loan book. The actual growth of the NPLs, actually, interestingly, they were driven by things outside of Jamaica. So they were loans that were done to, larger, almost syndicated type loans outside of the country, and so nothing systemic in there. But our growth in provisions over the last while was more to make sure that our coverage ratios got higher and more in line with what we would consider to be good conservative standards. So we're not too concerned about it on that side. The Hurricane Melissa will introduce we'll have to keep going through our assessments on the impact of Hurricane Melissa on NPLs, on provisioning, and so that'll kind of be what it'll be. The risk appetite part, I think, I will say that I'm not looking to increase our risk appetite in any way, but I don't think we have to increase our risk appetite in order to deploy the capital to support what I think will be quality businesses reinvesting in a growing economy. I don't think we have to increase our risk appetite to do that. I think we can do that in a very prudent way, in a very controlled way, in a very measured way. You've seen our statements on support for our long-term client, Jamaica Broilers, and that would be an example where some may think of it as saying, "Oh, you're increasing your risk appetite." We don't see it as increasing our risk appetite. We've done our diligence, we've done our assessments, and we think it's important to support a company through a troubled time, through a very challenging time. But we also think they have a strong domestic business in a very strong franchise in Jamaica, and so we think it's a very prudent use of assets, and not something that we're going outside of our risk appetite in order to do that. And I anticipate there are going to be many more like that coming out of Hurricane Melissa, because it's just a different shock. Jamaica Broilers had a shock that they had from the US, but it's a different shock. You look through the smoke screen, you look down deep, and you say, what is the quality of the business? What is the quality of the assets that are actually producing, and how efficient are they? And from that, determine how do we make sure that they have sufficient capital liquidity, because they have the earnings power to repay it, and repay it with coverage. So I use that as the analogy of why an NCB is important, because it's important to a Jamaica Broilers. But there are many more entities like that will be responding to the shock and the opportunity that comes out of Hurricane Melissa. We're uniquely positioned to do that, to support them. We know them well from history, and we're going to do that. And I don't think that in any way comes with an increase in risk appetite. We would not increase our risk appetite in order to do that. That would be, we definitely would not increase our risk appetite in order to support growth. I think growth comes without increasing our risk appetite.
Good deal. And I think I totally agree with you. And I'll give you one more, Melissa. I totally agree with you. There are going to be huge opportunities for you with the, $4 or $5 billion in capex that's going to be required to rebuild the country. And in the case of broilers, we had Chris Levy on the program last week, and he specifically mentioned the great support that they got from NCB Group. And our understanding is that you've restructured and gotten more security to support that financing. In fact, maybe it was unsecured before, and now you've restructured it with a pretty good security package. So you're not, in effect, really increasing your risk appetite in that regard at all.
Absolutely, Dan. That's one of the things that when Angus mentioned about the corporate investment banking, the centers of excellence, we have to get smarter. And one of the ideas is by creating these centers of excellence, we want to be able to support our customers when they need it. And we want to do it in a way that is very prudent, and that means between our technology and our people, we have to get collectively smarter, and that's that's a big part of what we've been doing, getting our technology more resilient, moved it into the cloud, invest in new systems so we have better data, better access to information, and then also concentrate all of our people that are otherwise fragmented so they can compound their knowledge and their expertise to develop solutions that both reduce risk as well as support our clients. So that thank you for recognizing that, but that's exactly what we've been working on.
Excellent. And I'll put on my Wigton cap for 2 seconds, Angus. I'm going to give you a phone call because we're going to need your support at Wigton too. Not because we're having any difficulties, because we have huge amount of capital to deploy as well too. And I think you guys would be a great partner in that regard.
Yeah.
Melissa, you have one more question, I would imagine?
So,
And then folks will go to the ones online. We've got a few questions online.
okay. So one final question. What is the expected organic loan growth? And how does this influence your capital deployment, whether via your loan books, the securitization that you're going to look at, or your liquidity buffers?
Again, everything punctuates on Hurricane Melissa. I would have said our organic loan growth, it's mid-single digits kind of thing. That across our business, given our market shares, our approach was to. It's very hard for us to grow much more than the market, if you will, and so roughly growing in line with the economy. And then just keep on tightening up on efficiency, get more constant. Our strategy was to primary customers, share of wallet, which creates a much more efficient business model. But on the whole, on growth, it's very hard for us to dramatically outgrow the economy. And so our approach, we would have been looking at kind of mid-single digit type loan growth organically. The punctuation on Hurricane Melissa, as I said, is it completely changes the numbers on what is the economic growth. And so you may get a quarter of slower economic growth followed by that V-shaped recovery that people talked about in COVID. And if you get that kind of thing, then we'll have much higher organic growth in loan. I don't think it'll be on our balance sheet. Again, why we put corporate and investment banking together is we want to leverage the huge scale of our balance sheet. But Angus mentioned the very, very large off balance sheet, the pension assets and the mutual fund and other assets that we manage. And we want to make sure that we're creating wealth for those pensioners, we're creating wealth for those mutual fund investors. And so we want to make sure that capital gets put to work well. But that's probably where a lot of that capital raising goes, not disproportionately to on the balance sheet, because we want to keep the balance sheet, the company well capitalized, exceed all our capital ratios with buffers. So a lot of that we'll make use of the combination of the corporate balance sheet and the investment banking side of the business to meet the demands of the country through the rebuild effort.
Good deal. Appreciate that. Okay, and with that, I think we'll take a few questions from online. And Angus, I want to kick the first one out to you. Comes from Kirk Gibson, and I'm going to do a two-part hit. So he's asking, hey, what's the IPO pipeline looking like for NCB Capital Markets? And then the second question I'll add to that, Angus, is could we see you guys doing any more U.S. capital market raises in the next 12 months, you think, for some of your clients? So you've done it for yourself. What are the chances we could see you doing something like that for one of your clients?
Sure, great questions. So we expect that interest rates may stay stable in the short to medium term, right? So we think that the storm is going to create some inflationary pressures. We think that the Bank of Jamaica will hold strain for now. We're baking in some sort of movement probably later in the calendar year, and that affects the appetite for coming to market to do an IPO. From what I have sight of now, there are at least two junior IPOs and two major mid-market IPOs that we're working on to bring to market in 2026. And then with respect to the US dollar raises, recall now that NCB Financial Group is a regional firm, and I would have received news today that in one of our operating subsidiaries, we were just mandated with a very large US dollar bond issue. Can't say what it is at this point in time, but certainly across the region, Dan, we remain very active. So we've done two very large transactions in Barbados. We soon do a large one in Trinidad, and we, as I said, we have 50% of the market share, capital markets wise, here in Jamaica.
Yep, no doubt. You're big and bad. Enough respect. Pat, do you see any questions there on online that you want to throw at them?
Sure. Another one from Kirk Gibson. Over to the NCB team. Any considerations around any inorganic growth to continue and broadening your presence in the region?
Nothing that we're looking at in terms of inorganic. It wouldn't be not a major feature for us right now. We have a lot to do. Again, if I punctuate it with Hurricane Melissa, there's a lot to do just on focusing on making our business more efficient and taking it up closer to a 20% type ROE, moving it up in that range, just by executing and focus on executing on the strategy, the platform that we have right now. We've moved, like I mentioned, we just completed moving most of our IT into the cloud, into Google Cloud. Our physical plant is strong, our capital base is strong, our liquidity is strong. We have to realize on that efficiency to get ourselves more efficient so we can scale from a more efficient base. We do not want to do inorganic until we become much more efficient. So that would be our overall strategy.
Good deal. And I saw from Kirk Gibson, so I think that question would have been asked, Kirk. You asked about any consideration for a share buyback. I think we addressed that. I also see a question from somebody saying, so we did the inorganic growth. Somebody asked about Rasta 1412, asked about when will the group increase dividends. I think Rob also answered that question pretty impressively. Lovebirds asks, we see where Trinidad is imposing an asset tax. What effects, if any, will that have on NCB Financial Group and GHL?
So we've factored it into the Guardian budgets right now. It's not quite clear how it'll be implemented, so there's still uncertainty on in terms of what the impact will be. We've factored it into our budgets for next year, and maybe the main message in the conversation with Gary I was trying to communicate is on these various things like asset taxes and any other type of external price inflation into the business. We're just trying to make sure that we're very much more proactive. To the extent that we can absorb things through efficiency, we will. But beyond that, we'd be looking to get efficient and provide our customers better value regardless. So when we get external price inflation type shocks, we're just building it into our business model. We're just adjusting the business model to incorporate it, not absorb it. And so I would say, from an impact perspective on the business of NCBFG, insurance is a little bit more long term, so you got a bit of a back book that you have to run through. But I'm not anticipating that asset tax would have any material impact. We would expect the Guardian business to adjust and find other things to offset, ways to increase revenue or reduce other expenses, so the asset tax doesn't have a net effect on the profitability of Guardian.
Okay, that makes sense. And with that, I think we would like to pretty much bring today's program to an end. I think it was a great comprehensive meeting. I'm sure you guys out there fully appreciated all of the insights we got from Rob, from Angus, and from Malcolm. So with that, we'll bring today's discussion to an end. And I'd like to thank our viewers as usual for tuning in. Your support is always greatly appreciated. Big thanks to Rob, to Malcolm, and to Angus for coming on the show, always coming and giving us great insights. We appreciate that, guys.
Super. Thank you very much,
Thank you.
Patrick, Gary, and Melissa.
That is correct, not Melissa. And of course, I'd like to thank our fellow panelists, my CEO, Patrick, and Melissa and Gary, our our executive chairman, for his insights as well. Too, folks, if you're curious about updates on a virtual investor forum, then you can find us on social media where we share our live stream dates and our upcoming guests on our official social media pages. So give us a follow up to learn about all things forum related. And don't forget to subscribe to our YouTube channel, Mayberry Investments Limited, and click that bell to receive future notifications. Well, remember, wise investors, slow and steady wins the race. Keep safe, y'all. We'll be back next week.